What if I told you that the world's greatest investor has been quietly screaming a warning for the past 2 years, and most people completely missed it? While investors celebrated soaring markets in 2024 and 2025, Warren Buffett was doing something extraordinary, quietly heading for the exits, systematically selling billions of dollars worth of equities, quarter after quarter. And now? The S&P 500 has fallen approximately 11% year-to-date, while Berkshire Hathaway stock has risen about 12% over the same period, a gap of roughly 23 percentage points. Buffett wasn't panicking. He was preparing. And in today's video, I'm going to show you exactly what he did, and what you can do right now to recession-proof your finances before it's too late. Stay with me. This one could save your portfolio. So first, why are we even talking about a recession in 2026? Goldman Sachs has raised its recession probability to 45% in mid-April, up from just 20% 2 weeks earlier. And analysts at JP Morgan are even more pessimistic, estimating a 60% probability of a recession, with tariff policies cited as the key trigger. That's not a small warning. That's the biggest banks on Wall Street waving red flags. And then there's the Buffett indicator, a metric Warren Buffett himself once called his favorite measure of market valuation. This indicator, which compares the U.S. stock market to the overall U.S. economy, has surged to 230%. Buffett once warned that if it approached 200%, investors were playing with fire. We're now well past that threshold. The S&P 500's cyclically adjusted P/E ratio, the CAPE ratio, is above 39, the highest it's been in 25 years. So what did Buffett do with all of this information? He acted. Quietly, methodically, brilliantly. Let's break down his playbook, step by step. Rule number 1 from the Oracle of Omaha: cash is king before a storm. Buffett has been a net stock seller, selling more than he buys in dollar terms, for the last 12 consecutive quarters. But he hasn't sold everything. Berkshire still holds $267.2 billion in stocks. Berkshire Hathaway's cash pile recently sat at nearly $392 billion, a 200% increase over the past 3 years, and the highest in the company's history. Now, you might be thinking, I'm not a billionaire, I can't just hoard $392 billion. Fair. But the principle is what matters here. Buffett told CNBC that his strategy ahead of a recession is to keep plenty of cash on hand so that people are going to keep making intelligent decisions rather than those forced upon them. Forced decisions. Think about that. When a recession hits and you have no cash buffer, you're forced to sell at the worst possible time just to cover your bills. You lose on both ends, your investments tank and you sell them low. The practical takeaway? Start building your emergency fund now. 3 to 6 months of expenses, minimum. Keep it liquid. Keep it accessible. Because when opportunity knocks during a downturn, you want to be the one who answers the door. Here's where most regular investors go wrong. They see a recession coming and they hit the panic button. Buffett's message? Don't. In a recent CNBC interview, Buffett was undaunted by market losses, saying, 3 times since I've taken over Berkshire, it's gone down more than 50%. This is nothing. 3 times. Down more than 50%. And Berkshire is still one of the greatest wealth-generating machines in history. Even as Buffett reduced Berkshire's Apple position by 41.8 million shares, he still retained $60.7 billion worth of Apple stock. Buffett's measured approach is both a reflection of his long-time faith in the U.S. stock market and a lesson in how not to overreact. And the data backs this up completely. Between 1990 and 2024, the S&P 500 generated annualized returns of 10.7% for those who stayed fully invested. But investors who missed just the 15 best days during that period only saw returns of 7.6%. Miss just 15 days out of 34 years, and you lose nearly 3% per year in returns. Compounded over decades, that's a fortune. So what does Buffett recommend? Stay in. Trim strategically if valuations are extreme. But do not go to zero. Because, as he famously wrote, equities will almost certainly outperform cash over the next decade, probably by a substantial degree. Now here is the philosophy that separates the truly wealthy from everyone else. It comes from Buffett's legendary 2008 New York Times op-ed, written at the very bottom of the Great Recession when the entire world felt like it was ending financially. Buffett wrote, "A simple rule dictates my buying: be fearful when others are greedy, and be greedy when others are fearful." And he backed it up with action. During the 2008 financial crisis, while others saw ruin, Buffett saw opportunity. He invested $5 billion in Goldman Sachs and ultimately netted Berkshire Hathaway over $3 billion in profit. As Buffett explained, "In short, bad news is an investor's best friend. It lets you buy a slice of America's future at a marked-down price." Think about what that means practically. Right now, many stocks feel expensive. But if a recession hits and prices drop 30, 40, even 50%, those same quality companies become incredible bargains. After Buffett's 2008 op-ed was published, the S&P 500 fell another 29% before reaching its lowest point. But it did recover, and those who stayed invested saw outstanding long-term returns. Those who waited until it felt safer to invest only captured a fraction of those gains. The lesson: recessions are not the end. They are sales events for long-term investors. Buffett doesn't just buy anything when the market drops. He's extremely selective. And this lesson is critical. One of Buffett's most famous quotes is, "It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price." And notice, he said company, not stock. During downturns, everything falls. Bad companies and great ones. Your job is to know the difference before the recession hits, so that when everything's on sale, you're reaching for the gems, not the junk. What makes a wonderful company, by Buffett's standard? Strong businesses that can pull through a recession are those with real competitive advantages, experienced leadership, and healthy financials. Even the strongest companies may see their stock prices fall during a recession, but if their fundamentals are solid, they will rebound. A practical example: Berkshire took a position in healthcare giant United Health after it plunged to a P/E ratio of 11. It also took a position in Alphabet when its average P was 22, and today that ratio sits at 31. That's the Buffett playbook in action. Research quality businesses now. Build your watch list. And when prices fall, be ready to move. One more piece of the Buffett puzzle: diversification, but not blind diversification. Goldman Sachs CEO David Solomon warned in November 2025 that it's likely there will be a 10% to 20% drawdown in equity markets sometime in the next 12 to 24 months, suggesting that diversification isn't just smart, it's essential. Buffett himself has long argued that for most people, not professional investors, the smartest move is a low-cost S&P 500 index fund. It gives you exposure to 500 of America's best companies, automatically diversified, at minimal cost. But diversification also means not having all your net worth tied up in volatile assets. Have some cash. Maybe some bonds. Consider real assets. The goal isn't to eliminate risk, it's to ensure that a market crash doesn't wipe out your entire financial life. And critically, by taking Buffett's advice to be greedy in down times, you can not only survive any upcoming recession but potentially set yourself up for life-changing gains during the recovery period. Now let's zoom all the way out, because this is the mindset that has made Warren Buffett the greatest investor of all time. After the 2008 crisis, the S&P 500 soared more than 300% between 2009 and 2019. The investors who reaped the biggest rewards were those who kept buying throughout the market's lowest points. History has proven this pattern time and again, through the Great Depression of the 1930s, the inflation of the 1970s, the Great Recession of 2008, and the COVID crash of 2020. All of them looked catastrophic in the moment. All of them ended. And the market went higher. Buffett's core belief is simple: America's economy and its great companies will keep growing over the long run. Recessions are bumps, not cliffs. And the investors who panic and flee are the ones who get hurt most. As Buffett once said of investors who only buy when they feel comfortable and sell when headlines scare them, those are the hapless ones. Don't be hapless. Be prepared. So let's recap Buffett's 5-step recession playbook. 1. Build your cash cushion. Emergency fund, liquid savings. Don't be forced into bad decisions. 2. Don't panic sell. Stay invested. Missing just a few good days destroys your long-term returns. 3. Be greedy when others are fearful. Recessions are sales. Have a watch list ready. 4. Own wonderful companies. Research quality businesses now before prices fall. 5. Diversify intelligently. Index funds, some cash, don't bet everything on one sector. A recession might be coming. Or it might not. But the beauty of Buffett's approach is that it works in both scenarios. If there's no recession, you're still building wealth. If there is, you're positioned to thrive. If this video gave you value, hit that like button, drop a comment telling me what you're doing to prepare, and subscribe so you don't miss the next one. See you there.